Hey everyone, Scott here, and this week we're going to talk about investments, and specifically we're going to talk about the roof of your financial house. So in the roof, this is where you're taking risk with the expectation that your return is going to be higher, because when you have all your money in the foundation, your returns are just not going to be as high because it's safer, it's secure. So right now, for instance, if you're invested in cash or CDs or treasury bonds, at best, you're getting 1 to 2%. So in the roof, this is where you can really get a higher return over time. So the first asset class we're going to talk about that goes in the roof is the most popular one, the one that we talk a lot about around here, and that's the stock market. So I get asked the question a lot, isn't the stock market just gambling? And my answer to that is absolutely not. Here's why it's different from gambling. When you gamble, when you place a bet, it is an all or nothing result. You either win the bet or you lose it and you've lost all of your money. With the stock market, you're investing in companies that are producing something, they're providing value, they're hopefully growing over time. And as they grow, your investment should grow with it. Now, if that company stops growing, if that company starts to come on hard times, the value of your investment is going to start dropping. It's very rare that a company goes all the way to zero, but it does happen occasionally. But the beauty of the stock market is that you can spread out that risk. You can invest in hundreds of different companies using different funds, or you can just pick 10 to 15 to 20 really good companies that you're going to hang on to for a long time. That spreads out your risk, and that is what makes investing in the stock market so much different than gambling. Now, when you invest in the stock market, you do take on risk, and you're going to have to deal with the ups and downs, the swings of value. You're going to see a lot of volatility in the stock market, meaning one day it might be up, the next day it's down, over and over, hour by hour, second by second, the stock market swings. But what do you get in return for that risk that you're taking and the volatility that you have? You're getting a higher rate of return. So historically, the stock market has returned about 10% overall per year. Now, that does not mean that every year it's earning exactly 10%, but over time, it averages out to 10%. So earning 10% on your money is a whole lot better than earning 1 to 2%, but you got to trade that risk and that volatility in order to get it. Okay, so what's another asset that goes in the roof? Another one that we get asked a lot about is gold. So is gold safer than the stock market? I get asked that a lot. And my answer to that is not necessarily. Gold is different than the stock market. It is a diversifier, meaning that when the stock market is down, gold has a chance to be up because it's something that's totally separate from the market. So it's a good diversifier, but it's not necessarily safer. It can have huge drops, it can lose a lot of value, and it has quite a bit of volatility. So how much has gold returned historically? Well, since 1971, gold has averaged about 10%, a little bit over 10%. So it's right in that same range as the stock market. Once again, pretty good option for long-term value. Now, the difference with gold is that it's not producing anything. It's not like a company that's growing. Gold has value because we as society has put value on it. Now, it does have some utility. We can use it in manufacturing. We can use it for certain purposes, but overall, gold has value because it's scarce. There's not a lot of it in the world, all things considered, and because we've placed value on it for a very long time in human history. So it's valuable for different reasons than the stock market. So another asset class that falls under the roof would be something like collectibles. That's guns, art, coins, baseball cards. These returns on collectibles are going to be very dependent on the specifics of the collectible that you own. So there's not necessarily an overarching 10% return that they've gotten. It just depends so much on your specific collection. Now, a downside to collectibles is that there's not just a free-flowing super transparent market for collectibles. A lot of times it's less liquid. So if you have a collection of coins or a collection of baseball cards, it might not be as easy to just go to a market and sell all that. Or if you do, you don't know if you're getting the right price. So it's not like the stock market or with gold where you can check the price of that at any time. Collectibles are a little bit harder. You might have to get an appraiser involved. So there might be extra cost, more headaches involved. And so all in all, collectibles are much less liquid than some of the other options you might have. But it can still be a good diversifier and can get you high returns over time. So there you go. That's the different areas that fall into the roof of your financial house. That's where you're taking risk and getting a higher return for long-term growth. And it's an important part of your investment plan, an important part of your overall financial health. So if you want to check out any of our past videos, go to carlsonfinancial.com and go to Carl's Corner. You can see all of our past ones and check us out there, or you can give us a call at 844-CARLSON to set an appointment with an advisor. Till next time, we'll see you next week.